What Chapter 2 will deal with is primarily the conceptual framework and accounting theory. Now, again, as we said, this is an important part of what we're going to be doing. This becomes the foundation for GAAP standards sections. First, explain what a conceptual framework is, then tell you why it exists, why it's important to have one. Then we'll look at the components, what goes into the conceptual framework. There's the objective of financial reporting. There are the qualitative characteristics, including fundamental and enhancing qualities. In the next module, we'll look at elements and principles and assumptions and various theories that you'll see. You've seen some of the historical cost going concern, but we'll go over those again. So really, to answer the question, what is the foundation for all GAAP? It is the conceptual framework. Now, the conceptual framework, what is it? It's an underlying foundation for all of the theory and all of the principles that we're going to be looking at throughout Intermediate 1 and 2 and Advanced Accounting and all of the other courses that contain. But it does not prescribe gaps. There's an important statement there. It is not really part of generally accepted accounting principles. It's not found in the codification. So it is really the theory that we use to develop GAAP, but it is not GAAP itself, if that makes sense. So it's not GAAP, but it is, in fact, the theory that is used to develop those standards. And right now, in effect, we've got what are known as statements of financial accounting concepts. So this is the body of standards that are in place. These are not accounting standards updates. They're not part of the codification. It's a separate group of documents that are issued to promulgate the theory. And the ones that are in effect now are just essentially 5, 6, 7, and 8. We put 8 first because this is considered, sometimes it's called topic number 1, because this is something that we just revised. So you sometimes see this reference, concept statement 8. By the way, you do not have to memorize. So if I ask you a multiple choice question, I'm not going to say, give me the number of the concept statement. Is it 8, 5, 7? Now, you don't have to memorize that. But just for reference purposes, concept statement 8 handles, number 1, the objective of financial reporting and the qualitative characteristics that make accounting information useful. That's what we'll cover in this module. Next module, we're going to hit the elements of financial statements, which you know already are assets, liabilities, but we're going to sort of fine-tune that understanding a little bit more. And number 5 will be the recognition and measurement principles, which you've already seen. Historical cost, going concern, business entity concept is involved with that as well. Now, concept statement 7 deals with cash flows and present values, and we'll bring this in as we cover the topics in Intermediate 1 and 2. It is not something that we're going to cover in this course specifically. So, conceptual framework. It is the foundation for GAAP. What are the objectives? So these are the purposes of the conceptual framework. And these are, number 1, well, as we said before, it's used to guide the development of new standards. That's first and foremost that the conceptual framework is going to be used by standard setters to develop new principles, and I'll show you how that's done. Second, if a standard that is in place comes into question, we use the framework to justify it. So we might say, well, why are we using this particular method? Does it meet the qualitative characteristics? Does it meet the objective of financial reporting? It's also there to help us solve problems quickly and consistently, and once again, to enhance user confidence. Not only do we say that we've got generally accepted principles that, even though they're broadly defined, as we said on Tuesday, then they raise some questions because of the estimates and the subjectivity that's involved. At least it gives the user some degree of confidence that there's a standard foundation that's used for GAAP standards. Now, I'm going to tell you that this is not the first, won't be the last standard. We thought this one was logically linked, but it is currently being revised. The FASB is currently working on a new framework, so 8, or topic number 1, as it's called sometimes, is the most current revision. The International Accounting Standards Board is working on their own independently. Just to let you know that there is another set of concepts out there pretty similar. But we might want to ask, why do the frameworks fail? So let's discuss this for a minute. Number one is that maybe we don't respond quickly enough to changing environments, so that globalization, increase in technology, and social standards may not necessarily be met quickly enough. And on October 1st, I don't know if we're going to invite undergrads or not, but we have the former chair of the FASB, Bob Burrs, is coming here. He's going to do a presentation. And he actually worked on the codification. He was the chair of the FASB. He was a partner at PwC. I met him there once or twice, and I know he does some work for us here. But you'll see, maybe I'll put his presentation online if it's not open to everybody. In his presentation, he talks quite a bit about the Sustainability Accounting Standards Board of the green accounting issues that are now being absorbed by the profession. So not only do you have the FASB with accounting standards, but sustainability has become a big issue. And by the way, that is not in our framework. So the idea of sustainability in green accounting is being somewhat ignored by the conceptual framework, and that may be something we need to pick up in the revision. Maybe the framework's not necessary. You don't have a conceptual framework in law or medicine. Well, I would give you a counter argument and tell you that probably accounting is always faced with an inherent conflict of interest issue. That is because in auditing, not tax, but in auditing, we probably are the only profession that does not directly service the client that's paying us. In other words, we're really going to service the stockholders. So the way I like to look at it is to say we've got the, and I'll wait to see what I have on the screen. So let's say you got the CPA firm, and they're providing audit service to a corporation. Corporation pays the audit fee to the CPA firm. But the issue is that we're really providing feedback information to the stockholders. So we're really responsible for the stockholders. The audit report is a report that is addressed to the user of the financial statements. So the idea that the money is flowing from the corporation to the CPA firm, and yet the CPA firm is really representing the stockholders who are issuing statements that are used by the market, tends to create a bit of a conflict of interest issue. And then, of course, we know we've got the Financial Accounting Foundation that is going to oversee the FASB. And they issue the standards that are used by the CPA firm and the corporation. So we have the GAAP standards. And we know that corporations also contribute to the Financial Accounting Foundation. So the idea that the money is flowing from corporations into the profession is something that creates an inherent conflict of interest problem. And when you study auditing, you can see that all of the ethics standards are designed to make sure that not only are you in fact truly independent, but you appear to be independent. Now, meaning that if you go to work, let's say, for a large public accounting firm, and somebody in your family works for the client, you cannot audit that client. Somebody in your family holds a large position in a pension plan in the shares of that client, you've got to be taken off that audit client. Or at least you have to disclose that you've got those shares in your family, or you might even own them yourself. So we go an extra mile to appear. I mean, obviously we want to be independent ethically, but we have to be able to appear to be independent. And a lot of it stems from this conflict of interest that is inherently built into this profession. So that is one of the reasons that is proposed that a conceptual framework may be necessary. Some foundation needs to be in place to justify the structure of the profession. Now, the third reason is that, whether you know this or not, GAAP standards are not laws. So there's no enforcement power by the FASB. So if I decide not to use a GAAP standard, I have no legal liability. Of course, if someone uses the statements and then is deceived by the numbers, I could be sued, but I don't have to follow the GAAP standards. So GAAP standards have no enforcement, only professional compulsion, as we said. So there's no power of enforcement. SEC rules, on the other hand, are legally empowered. So that's probably why we have the conceptual framework. And that's why they probably fail. There's a lot of problems with rapidly changing environment. You know, maybe they're not necessary, and maybe because there's really no enforcement. But again, it's also what makes them necessary. So here's what the framework looks like. We have first the overall, the overriding or overarching issue is the objectives. So we have to make sure that whatever we do in accounting meets the objectives of financial reporting, which we will discuss. Then we want to look at the qualitative characteristics, and this kind of gets very fuzzy. Lots of theories, you got to pull it together. But what are the qualitative characteristics? There are fundamental and enhancing characteristics which we'll look at. We'll also deal with the elements of financial statements, point in time, period of time, and then we'll look at the recognition and measurement principles. So let's start with the actual framework and the way it is used to develop new standards or justify existing standards. So let me make this a little bit smaller so you can see it. And so basically, if I'm going to develop a new standard, I have to start with whether or not the proposed standard meets the objectives of reporting. And then as I'm developing the standard, I have to think about whether it has the characteristics that make information useful. I have to determine whether it affects the assets, liabilities, does it meet the definitions, the proper definitions of assets, liabilities, equities, revenues, and expenses. Is it supported by historical cost? Is it supported by going concern? And we look at the recognition and measurement principle. What constraints do we have? Well, cost benefit, we talked about that. You know, even though the standard may look very promising, if the benefits are not as high as the cost, or if the costs are higher, we don't go forward with that standard. And then we issue the standard and it affects the financial statements. So that's the cycle of developing a new standard. That's why we've got the framework. Does it meet the objectives? Does it have the characteristics that make information useful? Does it properly meet the elements by definition? Is it properly defined as an asset or liability? Is it backed up or supported by going concern, historical cost, or measurement principles? Any constraints on issuing that standard, and then we finally issue. The other way around, if we're trying to justify an existing standard, we would go into the financial statements and go in the other direction. We would say, well, what is being used in the financial statements right now, and what are people really using? Are they really making use of this standard? Take a look at the standard, take a look at the constraints, and then use the framework to justify the existing standard. Does it have the characteristics, and so on? So we use the elements here to both develop new standards as well as to justify existing standards. Now, we'll see this more as we go along. So let's start now with the first. If I'm developing a new standard, what is the objective? So in concept statement 8, or topic number 1 as it's sometimes called, we start with the objective of general purpose financial statements. And by definition, we say that it is an information objective. So you know this before you get here, that the objective of financial reporting is to provide information that's useful in making decisions. But what we have to do now is become much more specific. So not only in making investment and credit decisions, but also assessing the cash flow prospects of the firm. And when we look at cash flows, what we're worried about is projecting the amount, the timing, and the uncertainty. Of the firm's cash flows. The amount, the timing, and the uncertainty of the cash flows of the firm. So it has to be information that's useful in projecting the amount, the timing, and uncertainty of the cash flows of the firm. How many here, just by show of hands, have worked the time value of money and present values and all that? Okay, so we're going to go over more of that as well. But that's what we're talking about here, because if you think about, let's say, the time value of money, you got a 3-year forecast, so you want to project out the cash flows in periods 1, 2, and 3. You want to find out the amounts, the timing, when it's going to happen, and the discount rate. As we'll see, if we don't have this, we will see this, we are going to go back to it. The discount rate is the uncertainty. So we need a way to project these cash flows. We need a way to assess uncertainty. We need a way to determine the timing, and financial statements will hopefully do that. And then we want information that enables us to assess economic resources, claims, and changes. Now, this is just a disguised way of saying what? Well, learning about economic resources, what are economic resources in a company? What's another word for it? Assets, right. So, the claims against assets are what? Liabilities and equity, right? Because there's a creditor claim and an owner claim. And how do assets, liabilities, and equity change? They change by income and cash flow, right? By generating income and cash flow. So once again, basically the objectives are met by what? General purpose financial statements and the footnotes. That's basically what they're saying. Sometimes we have to translate these standards into English, which is basically what we're doing. So we're saying that the amount, the timing, and the uncertainty of those cash flows are part of the changes. But by the way, you know that these cash flows are important. What do we need to know about the cash flows of the firm? We need to know about the company's ability to pay dividends, interest, principal on loans, taxes, and investment. So we definitely need the cash flows for these purposes. And all of that would be built into the statements of the general purpose financial statements. So the general purpose financial statements are designed to best meet the objectives of financial reporting. So that's the basic objective, to provide information useful in making investment and credit decisions, but then it goes on to say to assess cash flow prospects, the amount, timing, the uncertainty of those cash flows, and information about economic resources, claims to the resources, and changes in them. General purpose financial statements and footnotes will, in fact, provide you with the information you need to make those decisions. All right, so let's just stop for a second. Look at the basic objective. That is the objective of financial reporting. That is the overriding or the overarching concept in the conceptual framework. Now we have to see how the rest of the framework can be used to satisfy the objective. Questions here before we move on? So that's the first, the objective. Now, in order to meet the objective, we have to provide information that has characteristics and qualities that make it useful. So that's the second part of concept statement number 8, and that is the qualitative characteristics that make financial information useful for decision-making purposes. The two primary, or I should say the main characteristics, are called fundamental and enhancement. Now you've got to know this. As I said, for exam 1, absolutely going to be on this exam. Definitely see it on the CPA. I've actually gone through yesterday. I spent the whole day looking at CPA exam questions loaded with this stuff. So you have to make sure you understand the framework. The framework is new. An older, not necessarily this textbook, but older editions of textbooks may have the older version. So what I want to do is start with the fundamental characteristics. The two, and by the way, everything that I'm saying here is in the following pages in the package. Two fundamental characteristics. What are the fundamental characteristics? They are relevance and faithful representation. Relevance and faithful representation. These are the fundamental characteristics. They are actually, as we're going to see, sometimes we have to trade off, which we'll talk about. First one, relevance. This means that the information that you provide is capable of making a difference in someone's decision. In order to be relevant, it has to possess three characteristics. It has to be useful in making predictions. So there you can use it, and remember, what are you predicting? You're predicting the amount, the time, and the uncertainty of cash flows, for example, and it ties back to the objective. Confirmatory value means that after you made a projection, is it confirmed or refuted? Is that correct? Was it a correct projection? And then finally, materiality. This is the significance. It basically means, when you see materiality, it means that it is significant enough to influence the judgment of a reasonably informed user. So when you see materiality, it means it is significant enough to influence the judgment of a reasonably informed user. Materiality can be quantitative or qualitative. What I mean by that is that the information could be a large dollar amount. So if the company has a loss of $80 million and that is 30% of its total assets, that is significant in and of itself. It may be qualitatively important. In other words, the SEC is investigating the company for potential fraud. You don't have a number, you don't have a dollar amount, but that is material. That will influence your judgment. That will have to be included in the financial statements. And that is what we call relevance. The second is faithful representation. Second fundamental, when something is faithfully represented, it means that the accounting numbers correctly represent the economic substance of the transaction. So to faithfully represent, it means the accounting numbers or the accounting will faithfully represent the economic substance of the transaction. In order to faithfully represent a transaction, it has to be complete. It has to have all the information you need to understand that underlying event. It must also be neutral. It's got to be free from bias and free from error. I'm going to tell you now that this is not free from 100% of the errors. You cannot be 100% free from error. You'll have material errors. So there's always going to be miscalculations and estimates. It's not 100% accurate. So the word accuracy, we're going to talk about that when we look at some of the questions. Kind of strange, it's not really 100% accurate, free from material error. So that's what makes information faithfully represented. Now, we're going to have a trade-off between the two. Typically in accounting, we'll have a trade-off. Give an example of something that you had in intro to accounting. We'll see this in module 2. Historical cost versus fair value. So measuring a building, measuring land at fair value versus historical cost. Which one's more relevant to the user? Which one? Fair value. Right, fair value is much more relevant to a user, but historical cost is more faithfully represented. So we've got a trade-off there. And this will continually take place in accounting, where we have to make a decision as to what characteristic we want this information to satisfy. Which fundamental characteristic are we emphasizing? And this happens in practice. Now, I'm giving this as an example just to let you know that this is not just sort of theory that you're going to put in a drawer somewhere and never read it again. It is used in practice. There's a lot of application. So do we believe in the relevance? Do we want the relevance to be paramount in our standard, or do we want it to be faithfully represented? And sometimes you've got to have a trade-off. And we'll also see this in our enhancing characteristics. All right, so any questions on the fundamental characteristics? Yeah.
You say that relevance also is subjective.
Is relevance? Yeah, relevance may have more subjectivity, and that's where the trade-off comes in. Because, first of all, the predictive value and the confirmatory value, predictive value in particular, is going to make more estimates. So if you have a projection that's going to be more relevant, it's going to lack probably accuracy in a sense, or have more errors. It may not be complete, but again, it could be more relevant. So in a quarterly report that's not audited, we're giving you more relevant information. So there is probably more subjectivity in the relevance. And we'll see that in a minute when we look at some of the enhancing characteristics. Anything else on the fundamental? We'll do some more applications as we move along. Excuse me. Now, the enhancing. In order to enhance both both of the fundamental characteristics, both relevancy, faith, and representation. You want information to be comparable, you want it to be verifiable, you'd like it to be timely and understandable. So comparability, this is a strange one to me because it allows users of financial information to compare various entities, the similarities and differences among various entities. But I'm going to tell you that that's kind of limited when it says several entities. What about consistency? What if a company changes a method from one period to the next? Even if it's one company, it means it's not what? Comparable, right? I can't compare. So I change an accounting method this year. I can't compare, possibly won't be able to compare 2018 to 2017. So comparability to me, when I said it's strange, does not really only apply to multiple entities. I think it applies within the same entity over time. So when you look at comparability, I would rather you view this as multiple entities at a point in time with the same entity over a period of time. You want to be able to compare the same company year after year, because you want consistent application of GAAP, but you also want to be able to compare 5 different companies in that industry. So in the auto industry, you want to compare Toyota to Honda to General Motors, but you also want to take Toyota's financials and compare them over time. And that's where the consistency comes in. That enhances the value of the information. Verifiability also enhances. That's where you have basically the ability to say that if all of us got together and we looked at the same information, we would all come up with the same conclusion. We'd have a consensus decision. So that if we wanted to find out what your client paid for a building, we would take a look at the closing documents from the lawyers. We would take a look at the mortgage. We would take a look at the surveys, and we would see that we could come up with the same decision. Timely. Information gets there fast enough so that you can make a decision. And this is where you get another trade-off, in the sense that if you look at historical cost versus fair value, what about annual versus quarterly? Quarterly statements. Which is more relevant, which is more reliable? Well, we know that quarterly statements are more timely. The timeliness makes them more what? Relevant, and they're less faithfully represented. So once again, there's going to be this trade-off. You get more relevant, and by the way, that's where you said about estimates, because the quarterly statements are loaded with estimates. They're not actual. All right, and finally, understandability, pretty simple, just means that a reasonably informed user will be able to perceive the decision usefulness of the information. A reasonably informed user will perceive the decision usefulness of the information. So someone that has a reasonable background will be able to perceive or understand that the information is useful. So those are the characteristics. Now we enhance it. We will take a look at some questions and show you how these have to be done. Now, the only thing we need to do is consider the possibility of constraints. And everything we just said here is, all of this is the definitions that we just discussed. But the only constraint that's in the conceptual framework is cost effectiveness or cost benefit. So, in other words, we're not going to provide accounting information, or we're not going to follow GAAP unless the benefits exceed the costs. So when you talk about constraints, the only constraint that's formally stated in the conceptual framework is cost effectiveness. Now, it means that the standard, applying the standard, whatever it may be, the benefits have to exceed the cost. And I think we had a little discussion here already that the benefits are much more difficult to estimate. The costs are pretty easy of a new standard, right? You have to retrain your employees, you have to renegotiate contracts, whatever you want to do. I'm going to add, although it's a degree of relevance, I'm going to add materiality because materiality is also a constraint in some ways. Now again, if you were doing this on the CPA exam, you would have to say that relevance, that materiality is part of relevance. But you have to remember that materiality is really a constraint. In a sense that if something's not material, you don't have to follow GAAP. If something is material, you have to, or you have to provide that information. And again, by definition, it means that it is material enough to impact the judgment of a reasonably informed user. Okay. All right, so number one, the FASB's decisions are based on investors being informed opinion about cash flow, and we know that is true. That is true. All right, so let's just see how much we picked up over the last 40 minutes or so. Let's take number two. A is true, B is false. Qualitative characteristics that are listed. How do we label them? Okay, so it is false, so the correct answer would have been fundamental and enhancing. Okay, fundamental and enhancing. Number two would be false. Let's try number three on relevance. Of an economic event. The answer is false, because that is really the other fundamental characteristic, which is what? Faithful representation. So this is not relevance, it's faithful representation. So three is false, that's faithful representation, not relevance. All right, let's see number four. I'm going to take this one myself. And number five, I'll take myself, because we just did those 3 seconds ago. And that is predictive value. If it provides feedback, well, that's absolutely not true. Relevance has 3 characteristics, right? It's got to be predictive value, confirmatory value, and materiality. So this is predictive value is not feedback. That's the second. This would be confirmatory. This would be feedback would be confirmatory. And so that would be false. And 5, we know that materiality does not have to be expressed quantitatively. It could be qualitative as well. Number five is true. It's true. It's not always quantitative. It could be qualitative. As we said, if the SEC is investigating a company for fraud, there's no dollar amount there yet, and it's material. It's material. Now, number 6 and 7, as I said, kind of difficult to play with because accuracy. It's true. I mean, I guess free from error is accurate, but what the term means, free from error, in faithful representation, means free from material error. So I just want you to know that even though it's not 100% accurate, it could be considered free from error. So the word is free from material error. So I would say we don't have an answer. I'm not going to give you an answer for 6 and 7. It's really more for discussion, but I would just let you know that I think for 6 and 7, you have to know that when we say free from error, it's free from material error. So accuracy, 100% accuracy is not possible in accounting. It's not possible. So you could still have a faithfully represented set of statements if there are some estimates in there that are not 100% accurate. It could still be faithfully representing the transaction. All right. So now, see if we can do some multiple choice. All right, what does the framework assist with? Let's try this one. Let's see what we have. Okay. All right, all of the above. Well, that's the wild card, so that one makes sense. So we tried that, but throwing that one out, it is going to be C. So there are no absolute answers. I mean, you should have read the first one. Absolutely. I mean, this is right here. I mean, this is a killer right here. Absolute. I mean, really. That means 100% accurate answers. We don't have all these answers for accounting. We're not worried about looking for fraud. We're not doing audits. So that word in there is another throw-off that you just dump on that one. And it had to be C if you got rid of the first two. You normally can eliminate two on multiple choice. I'm not a good multiple choice person. I don't like the answer either. But that one I can tell you for sure. We're not dealing with auditing, and we're not dealing with absolutes at all in accounting. So it's got to be C. Let's try another one. And we're going to do a few more, and we're going to move on to two. Number two, this is a good one. So let's go to number two. I'll start the clock. Give you 1 minute on this. Usually 1 minute is pretty good for some of these. Computation, probably more than that. All right. So yes, good. Got that one. It is D. The conceptual framework has nothing to do with accounting standards. It does not override standards, nor does it get involved with issuing accounting standards. So it's absolutely correct. D is correct. Okay, great. So that one is good. All right, now, in number three, I'm going to take care of these for you. Number three, when you develop new standards, what's the first step? First step is the objectives. So when you develop, when we went through that circle, first thing we do is what's the first thing in the circle? Objectives. Second step in developing a new standard would be, so 3 is C, 4 is the consideration that the standard meets the qualitative characteristics. Number 5 is also C, because FASB are working independently with the ISB. Number 6, what are the 3 components of relevance? Predictive, confirmatory, and materiality. So that's going to be big. Now, not only do you have to, I guess, memorize this stuff, I don't necessarily like the word, but you also need to know what each one is at some point. All right, number 7, let's try this one together. Which is not, in other words, what is not an enhancing characteristic? Again, these are, I guess this one you have to memorize, but again, you've got to know what's inside. So what is not enhancing? What is not enhancing? Another thing you have to watch out for in multiple choice, except you're not, All right, so this one, yes, 100%. Excellent. That was easy enough. But the reason why I wanted that question was not because I hoped that you'd all get 100 on that. Consistency is not part of it. So I'll let you know that consistency is related to comparability. Because in the event that statements are not consistently using the same method, they're no longer comparable. So these are related, but not, so consistency is within comparability. Consistency falls within that. All right, let's do the last two, unless there are questions. Number 9, the answer is B. If you don't disclose information, it's not faithful representation. Is B. And so B is the answer to 9. Number 10 is fundamental characteristics we should know would be faithful representation and relevance. That's just knowing that as well. All right, so it gives you a good idea of what you need to know. Obviously, there's going to be more in terms of knowing how to apply this as we move later on, just in these trade-offs. All right, now, before we go to Module 2, any questions on the first part of the conceptual framework? All right, so let's go into 2. And here we're going to finish the framework by looking at the elements of the financial statements, as well as the recognition and measurement principles, which includes concepts, principles, and assumptions. So first is concept statement number 6. And these are the elements of the financial statements. Essentially, these are the elements that are going to be defined, and of course you know what they are. Just go to the next page. Their assets, liabilities, and equity. But when you think about the elements, what we have to make sure we understand is that we have 2 types or 2 groups of elements. We've got point in time and over a period of time element. Now, the point in time elements are predominantly balance sheet. Elements and over a period of time elements are primarily income statement related. Now, you're not going to be asked to memorize and kind of spit back exactly what's here, but you have to know a lot of components. So you should know that an asset is an economic benefit, a future economic benefit that's either obtained or controlled by the entity. Obtained means you have legal title. Control means you may not have legal title, but control it. How do you control an asset without owning it? You lease it. Right? You don't have to have legal title. Liabilities are probable future sacrifices of these economic benefits that result from a past transaction, or we know that will be settled in the future by sacrificing economic benefits. And equity, of course, are the net assets or the residual interests of the owners. Those are the point-in-time elements. Now, the period of time elements, or as I said, primarily income statement, but there are going to be some balance sheet elements here because it's really the change in the balance sheet. So let me just qualify that a little bit. Primarily income statement related and encompasses or includes balance sheet changes. So, investments by owners, buying capital stock, distributions to owners, dividends. We know revenues. We've already mentioned gains. Don't forget, we covered this already. Remember how to differentiate between revenues and gains. Gains are from peripheral or secondary activities. Revenues are from primary operating activities in the firm. Also, remember that revenues and gains are the same in a lot of ways, and those are that they're asset inflows or reductions of liabilities. So gains and revenues will be identical in the following sense. They both generate asset inflow or reduce liabilities, but they are different in that revenues are basic operating functions or central operations, where gains are resulting from peripheral activities. The same thing is to be said for your understanding of expenses versus losses. Expenses and losses are pretty much the same in the sense that they're asset outflows or increases in liabilities. Assets go out or liabilities go up when you have an expense or a loss. But the difference is, again, expenses are from the major or primary operations of the company, where losses are peripheral to that company's major operations. And then finally, what we have to do at some point, which will be in Chapter 5, is spend a lot of time on comprehensive income. Comprehensive income is really important for us these days because it is the change in wealth, except that these changes cannot come from transactions with owners. So it's the change in your wealth from all sources except owner-related transactions. So that it would exclude investments, it would exclude dividends, it would exclude treasury stock transactions. Any change in the wealth of the company except for those that result from transactions with owners. And the important thing to note is that comprehensive income, which I'll abbreviate, is equal to net income as you know it, plus or minus other comprehensive income. Now, other comprehensive income, we'll talk about this in Chapter 5 in a lot of detail, but it is going to include, I think you would call paper gains and losses. So right now, you may hold you may work and you may have a 401k plan, or someone in your family has a pension plan. Stock market goes up today, their wealth goes up. Is it a gain? Yeah. Is it income? Yes. Is it realized? No. So if you were reporting that to the government, or if you were preparing a tax return, you would not include the increase in your portfolio. Why not? You didn't sell it. It's unrealized. So no transaction took place. So these are paper gains and losses. So an example here would be an unrealized gain. Or loss on, let's say, securities. Hell, you didn't sell them, just holding on. And that'd be an example of other comprehensive income. Did your wealth go up? Yes. Is it part of reportable net income? No. We'll spend much more time on that in Chapter 5. So those are the elements. I would say, not going to memorize them, but you have to know the differences, and you have to know the basic definitions, but not to be sort of regurgitated on the exam, but just to be able to be applied. Everything we're going to do is going to be applied. Are there any questions on any of the elements? Again, a lot of this is just overview material, and we'll dig into this in more detail at some point. All right, so that is concept statement number 6. The last concept statement is number 5. And these are principles, concepts, modifying conventions, whatever you like to call them, assumptions, and I'm not going to worry about whether or not we call something the business entity concept, the business entity assumption, or the business entity principle. We need to know the substance. And these are the basic recognition and measurement principles that determine when and how much of a transaction is going to be recognized. It is also what I consider to be the principles that we follow on a day-to-day basis to make decision making. Now, concepts you've seen before, and the concepts that are historically related to the balance sheet. Now remember, balance sheet and income statement are interrelated, but the concepts that you typically see related to the balance sheet are the measurement principle or concept, the going concern concept. Conservatism, which believe it or not is not the conceptual framework, but is something that we use on a day-to-day basis, and the business entity concept. When we look at the measurement principle, here's where we get the trade-off between relevance and faithful representation. The measurement principle today, unlike what you might have seen in an intro to accounting class, consists of a mixed attributes model. So this concept or this measurement principle tells us that we can measure assets either at historical cost or at fair value. Now, although fair value is more limited, it is part of the measurement principle or concept. And I can't keep track of what books call which what, assumption, whatever it is. All right, so what's the historical cost concept? Well, you know that, and I don't think I have to tell you that. From basics in accounting, you know that the cost concept tells you that assets, liabilities, and equity are originally recorded at cost, and they stay at cost until they're used up in operations. You should also know that cost is the agreed upon acquisition price between a willing buyer and seller, both bargaining for their best interest. So if you and I were transacting, we would be looking to maximize our own position. And that arm's length transaction generates a price or a cost that is known as historical cost. Now, most assets in industries will rely on historical cost, meaning that it is the ceiling on asset valuation. So what this means is that cost over time, the minimum value would be zero. If the market changes, well, based on conservatism, if there are declines that are other than temporary, that is, if the market declines and there is what we call an impairment, we write the asset down. So in basics of accounting, you saw bad debt expense. That's an example of an impaired asset. So that, or lower of cost of market. So that if the market value declines, for an asset, it's impaired, and we take a loss. And it can go down to zero, right? That's the minimum. But if the market value goes up, it's not recognized. So we don't, and sometimes you recover up to cost, but you would never recognize market values in excess of cost. So as a result, if you adhere to the historical cost principle, it is in fact going to be a ceiling on asset valuation. You could go below cost if it's impaired, but you don't go above cost. Now, this is based on conservatism, but it's also based on faithful representation. So historical cost is less relevant, but is in fact much more faithfully representing the value of the asset. We continue to use cost even though it may not be relevant. We don't build in inflation because it is objective and subject to verification. Now, in fair value, we now see fair values for all equity securities, debt securities that are either held for trading or available for sale, notice these are held here, but I'm talking about securities that may go into net income if they're valued at fair value. So what that means is that you start out with cost, it could go down to 0, but we recognize losses down to market. And there's no ceiling on the gain if we're valuing at fair value. So you can mark securities to market above historical cost. You could have gains and losses. And once again, this is an example of relevance. So all equity securities, debt securities that are held for sale or trading, also derivatives. There's something we'll see later on in Intermediate 2 called a fair value option. Whether you heard this or not, you can value debt at fair value. So if you covered bonds in intro to accounting, you can have those bonds measured at fair value if you want. So you have a fair value option. So predominantly, I'm going to tell you that on the US GAAP, the fair value principle really only holds to financial instruments, either debt or equity, whether they're securities or liabilities. So the general rule in the United States is that fair value really only applies to financial instruments, financial assets, financial liabilities. So in the US, we'll get to IFRS. Financial assets and financial liabilities. Now, why do we, again, I mentioned, going back to the history of standard setting, we talked about the Depression, the market crash, the use of fair values and speculation in 1929, and the SEC said, you know what, historical cost is the only thing you could use. Why are we moving back to fair value? Well, because we've improved disclosures, and some fair values are probably just as faithfully representing the economic substance, better or as good as or better than historical cost. So what we've done, and by the way, if you got it right now, the day it closes at 4:30, you go ahead and get a stock price online for a security that you're holding, that value is not only relevant, but it is what? Faithfully represented. It's a closing price in the New York Stock Exchange that is probably more faithfully representing the value than the cost that you paid for that asset. So we now allow financial instruments to be valued at fair value, predominantly because of financial markets being reliable, and secondly, because of disclosures. We now have a required disclosure, which is known as a fair value hierarchy. In the footnotes to the financial statements, you have to tell the reader what financial instruments are carried or what assets are carried at fair value, because some can be impaired, don't forget, right? What are carried at fair value, and what's the level of reliability of the input into those values. So a level 1 is the most reliable. Level 1 would include a quoted market price for the identical asset or liability. So again, you open up your computer, you get a quote from the New York Stock Exchange today. That is level 1. That's a level 1. Level 2, this is where you don't have a quote for that asset. You don't have that asset traded, but you find it comparable. Now, if you don't know what a comparable security is, forget that. Think about buying a house. So let's say you're going to buy a house, or someone in your family is going to buy a house. How much are you going to pay for it? What do you look for? Well, in the neighborhood, you look for values that you make an appraisal, but you might look for a sale of a comparable home in the neighborhood. So you go online, you go on Zillow or these websites, and you find out that a house 2 doors down from the one you want to buy just sold for $400,000. And it's got almost everything that your house had. They were built at the same time in a development. So, you know what? If they got 400, that's my starting point. It's comparable. But the problem is it's not exact. So that's a level 2. And the reader needs to know that it's comparable. It's comparable. Recent selling price. Now, you could get an appraisal, but a comparable is a level 2. And both of these are observable inputs. Level 3 is the least reliable. A level 3 is an unobservable input based on management's models, discounted cash flow models or estimates of the asset's value. This is where you would not have a publicly traded security, you don't have a market for the asset. They're unobservable, and they are going to build in management's assumptions and judgment with respect to that asset. Those are the least reliable. And this would be something like valuing an asset at the expected cash flow, present value of the expected cash flows. So in the footnotes, the financials, I'm going to find out. I'm holding equity securities, level 1. I'm holding derivatives, level 3. Or I'm holding various securities at a level 3. What does it tell the reader? Well, let the buyer beware, in a sense. You're getting a warning that this is measured at fair value, but it's not faithfully represented. A level 1 is more faithfully represented. Now, all fair values are relevant, but they have more qualities. This is what I'm trying to really give you as an application here of the conceptual framework. So when you look at a disclosure, and General Motors or Apple tells you that they're holding securities, and you look at the security portfolio in the footnote, it says level 1, you know those are reliable values because the inputs are the highest quality and they faithfully represent, and they're also relevant. If Apple is holding derivative securities like options where we don't have a traded value as reliable, or a financial asset or liability that's not publicly traded, and there's an estimated value, that means that, okay, I've got a fair value, it's relevant, but it's not faithfully representing that value. So it's got less quality and it's less useful information. So the hierarchy is going to be disclosed in the footnotes to the financial statements. So this is a perfect application of the trade-off between relevance and faithful representation. Any questions on the hierarchy? Any questions on the hierarchy? Okay, so make sure you're familiar with this as well. All right. One last concept. We will pick this up next week, definitely starting 5. Going concern, I think you've seen this already. But let me now add what you need to know for at least the intermediate level. So when you look at a company and it's a going concern, it basically tells you that unless you have evidence to refute or evidence to the contrary, you're going to record transactions or classify financial statements, prepare financial statements, as if the entity will operate for an indefinite period of time. And that's a time not infinite, but indefinite. That's a time long enough to carry out contemplated operations, use up all its productive capacity, and would be able to pay off its liabilities. What's an application of going concern? The long-term and short-term classification on the balance sheet, or depreciating an asset for a 40-year period. You have to remember that we don't use market values all that often, and some people will tell you that the going concern concept is used as a justification for historical cost, because if you had a going concern, if a company is going to operate for an indefinite period, that means productive you're not going to sell off productive assets. In other words, if you're a going concern, you're not going to sell off your plant and equipment. If you're a going concern, you're not going to sell off all your buildings. So basically, your productive assets are not for sale. In this case, you might say that fair values are not relevant. And we do believe this in a lot of cases in US GAAP with respect to planned assets. If fair values are not relevant, then we're going to use historical cost. So, in this sense, historical cost and going concern will be related. Now, of course, in the event of a bankruptcy, and I've worked in a couple of bankruptcies, all the assets are valued how? Liquidation prices, fair value, right? You're going to sell them, market. So if you're in bankruptcy, you're not a going concern, correct? And therefore, all the assets are for sale, and fair values are relevant. So just think about, and that's why I'm building these models for you, because what I'm trying to establish is a way of thinking, not necessarily about this particular case, but how do you apply it someplace else? You go to a client and you're looking at something that you don't find in your textbook, thinking this through, well, if the company is a bankrupt entity, productive assets are for sale, fair values are relevant, and therefore we use fair value accounting. So again, and that's, by the way, why we have, think about going back to the fair value option that we give companies, because if I'm holding equity securities for trading on a regular basis, I'm going to value them at fair value. If I'm investing in derivatives that I'm trading every day, I'm going to value them at fair value. Why? I'm going to sell them. I'm not going to hold them long. I'm buying them to trade them quickly so the fair values become more relevant. And that's the whole concept of fair value accounting in the United States. That's why we don't value buildings and land at fair value in the US, because of that link with the going concern concept. IFRS is a bit different. They tend to think that it's relevant enough where they will value assets at fair value, whether they're buildings, land, or securities. All right, so we're going to pick this up. Definitely, we've got a few pages left here. We'll finish this off with conservatism. We're going to start 5 next week. 5 is where we start to now cross a line where we're going to get involved with lots of numbers and some detailed illustrations. So if you don't have the course packed yet, as I mentioned in my email this morning, really urge you to get that. Do it if you can to get up to speed. If you have any questions, I'll be here for a bit. But if not, good weekend. We'll see you on Tuesday.